Ever wondered how the Federal Reserve impacts your daily life? It's like the invisible puppet master pulling the strings of the economy. The Federal Reserve, or the Fed as it's commonly known, is the central bank of the United States, and it wields the power to control the monetary policy of the nation. Imagine, if you will, a lever that can be moved up or down. When the Fed wants to stimulate the economy, it lowers this lever, which translates to reducing interest rates. Lower interest rates make it cheaper for us to borrow money, encouraging spending and investment, and giving the economy a boost. On the flip side, when the economy is heating up a little too much, the Fed raises this lever, increasing interest rates. This makes borrowing money more expensive, causing us to tighten our belts and cool down the economy. So, whether you're buying a house, starting a business, or just shopping for groceries, the decisions of the Federal Reserve impact you. The power of the Federal Reserve rests in its ability to influence your wallet. Now imagine you're buying a house and you need a loan. The bank doesn't just have a pile of money sitting in the back room waiting for you to borrow. No, it's far more interesting than that. When you take that loan, the bank essentially creates new money right out of thin air. It's not magic, it's the mechanics of our monetary system. But here's the kicker. The cost of that loan, the interest you'll pay, isn't just determined by your credit score or the bank's generosity. It's influenced by the Federal Reserve, the central bank of the United States. They control what's known as the monetary policy, which is like the heartbeat of the economy. When the economy is sluggish, the Federal Reserve, or the Fed, as it's often called, can lower interest rates. This makes borrowing cheaper, encouraging people and businesses to take loans, buy homes, start projects, and essentially pump more money into the economy. On the flip side, when the economy is heating up too fast and there's a risk of inflation, the Fed can raise interest rates, making loans more expensive. This slows down borrowing and cools the economy a bit. So, you see, the decision to buy that dream house, the cost of the mortgage you'll pay, is not just about the price tag on the property. It's also about the state of the economy and the decisions made by a group of individuals at the Federal Reserve. So the cost of your dream house is not just about the price tag, it's also about the Federal Reserve's decisions. What happens when things don't go as planned? Let's delve into that. You see, the Federal Reserve's monetary policy can be a tricky balancing act. On one hand, lowering interest rates, a process known as quantitative easing, stimulates the economy by making it cheaper for people to borrow money. This sounds great, right? Well, not always. Here's the catch. When the Federal Reserve pours too much money into the economy, people can get carried away. They may borrow more than they can handle, becoming over-leveraged. This could lead to a dangerous bubble, where asset prices inflate beyond their real value. And as we've seen in past economic crises, bubbles can burst, leading to a sharp downturn. On the other hand, the Federal Reserve can tighten the money supply by raising interest rates. This is called quantitative tightening. The aim is to keep inflation in check by making borrowing more expensive. However, this tactic can also backfire. Higher interest rates can make it harder for people to repay their loans, leading to defaults and even bankruptcies. Take, for instance, a small business owner who took out a loan to expand her business. If interest rates rise unexpectedly, she might find herself unable to meet the higher loan repayments, putting her business at risk. So you see, the Federal Reserve's decisions are a bit of a double-edged sword. While they can stimulate economic growth and control inflation, if not handled correctly, they can also lead to financial instability and hardship. Yes, the Federal Reserve's decisions can be a double-edged sword. So where are we now in this grand scheme of things? As we stand today, we're in the midst of a quantitative tightening phase. This is the phase where the Federal Reserve hikes up interest rates, effectively reducing the amount of money in circulation. It's a bit like turning down the tap, slowing the flow of water, or in this case, money into the economy. Now, what does this mean for you and me? Well, borrowing becomes more expensive. Whether you're a business owner seeking a loan for expansion, or an average Joe looking to buy a new house, you'll be paying more in interest. In the broader economy, this tightening phase can slow down economic growth, as spending and investment tend to shrink when borrowing costs rise. But why would the Federal Reserve do this? It's about balance. The goal is to keep inflation at bay while still having the capacity to create money when necessary. But remember, this is a cycle. It's a financial seesaw of easing and tightening, and understanding this cycle can be the key to financial wisdom. Understanding these trends can help you navigate the financial waters with confidence. But there's more to this story than meets the eye. The dance of the Federal Reserve, this intricate ballet of easing and tightening, is not merely a cycle. It is a powerful wave that can sweep away the unprepared and reward those who understand its rhythm. This system, in its cyclical nature, can have a profound effect on wealth distribution. When the music of low interest rates plays, many are lured into the dance of borrowing. But when the tune changes to the somber notes of higher rates, those without a firm footing may find themselves stumbling, their dreams of prosperity slipping away. On the other hand, those who understand these cycles, who can anticipate the change in tempo, can ride this wave to financial success. They know when to step forward, when to retreat, and when to simply stand their ground. These cycles are not random. They are deliberately created and can lead to the loss of possessions for many individuals, benefiting those who understand the cycles. It's a game of musical chairs, and those who understand the tune have a distinct advantage. Knowledge is power, especially when it comes to the Federal Reserve. So what can you do about all of this? Information is your most powerful tool. It's essential to keep tabs on the decisions made by the Federal Reserve and understand how they might impact your financial world. Consider resources like financial news outlets, economic textbooks, or even online courses that delve into monetary policy. Engage in discussions, ask questions, and challenge your understanding. Knowledge is not just power, it's protection. Remember, the more you know, the better you can plan for your financial future. Stay informed, stay ahead,